Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Bird, and we're an hour away from the opening trade. Here's what you need to know. Another blowout payrolls number out of the States, sending yields and the dollar soaring. This market's priced out yet another Fed cut. And a fresh wave of U.S. sanctions against Russia sends oil surging, pressuring India and China, two of the world's largest oil-consuming nations. And speaking of, China's trade surplus soared to a record $1 trillion as exporters rushed to preempt President-elect Donald Trump's return to the White House. Lizzy.
Well, Kriti, this is anything but a quiet start to 2025. We had good news being back to bad news on Friday with that blowout US jobs report. The S&P taking a beating. Bank of America saying rate cuts were so 2024. You saw the 10-year yield climbing. Currently 4.75% is where we trade. Keep an eye on cable today. We could see further weakness for the pound. Euro Stoxx 50 futures pointing lower, and Brent back above $80 a barrel after these sweeping US sanctions on Russia. The countdown to the opening trade starts right now.
Monday the 13th, good morning. Will this week be even more brutal than last week? Buckle up, we've got an awful lot going on. In around 30 minutes' time, we're going to kick the week off with a rocket launch. That's going to be happening at Cape Canaveral. We'll look forward to that one. Jeff Bezos launching his latest rocket. But the week has an incredible agenda ahead of it in terms of the events that could be shaking markets. We've just seen, we're about to get, I've yet to get a first price on my screen, a first trade on US Treasuries. Obviously shaken heavily Friday as we saw that payroll number coming through. But this week has got plenty of events, Kriti, that could continue that turbulence.
And even as we do get those early opening trades around the U.S. Treasury market, 475 still on the 10-year. That's the closing price that we've last seen when it comes to the state story. Then is the dollar. I mean, yet another payrolls number. Is economic resilience a problem? Is hiring a reason to cut your stakes in some of these companies?
The long-duration trade looks like it's beginning to come under quite significant pressure, isn't it? The market has built up this long-duration trade over the last few years. Tech's done well out of it. This idea the rates are going to remain low. Lizzy, that is being questioned, not only in the United States, but the ripple effect around the world is absolutely enormous.
Yeah, do we start to see this showing up again in gilt yields this morning? Problems for Rachel Reeves at the open potentially again. But also, you know, if the Fed isn't going to help stocks, are we going to have to rely on the banks' earnings this week to give that boost to the S&P this week? You've also got potentially the read-through from the oil price story as well. We've seen Brent rising above $80 a barrel for the first time in 4 months. This as the US has imposed the most aggressive bout of sanctions yet on Russia's oil industry. So keep an eye on the oil price as well.
The oil price is going to be absolutely fascinating in as much as what it's going to also add into is this risk around what happens with inflation.
Yeah.
We've got PPI, then CPI. We've got PPI. We've got CPI data also here in the UK. This idea that energy prices were going to be weakening up seems to be being questioned as well. The input factor into what is happening around inflation, the input story in all of that, looks like it's moving against the Fed right now. We've also got claims coming up later on this week as well. It's a really tough trade for what is happening around the narrative of inflation comes down, it is stabilising, the Fed can cut rates. More and more banks taking these rate cuts off the table, and everything needs to adjust off the back of this. Is it 5%? Do we get to 5%? Is it then 6%? Do we get to 5.50? What are the kind of narratives that we should be looking for here? The ripple effect is absolutely enormous into all asset classes.
And I think the ripple effect that you're seeing, at least notably, is not only in that dollar surge that you had referenced as well, but the weakness that you're seeing on the euro off the back of it, the pound, as Lizzy mentioned, the gilt story we're going to be watching in a moment. A 102 handle on euro dollar. We got to parity so quickly, and none of it really has to do with the change in the European fundamentals. It's really, at the ultimate, at the end of the day, a dollar story. That's a similar story Lizzy was talking about with China as well, excuse me, with the oil story as well, relative to Russia, that having implication on China. This is a story coming out of Washington, whether you look at the bond yields, whether you look at the oil story, whether you look at the currency story. Do we even factor in the other side of the world?
Maybe, but this, as you say, is being driven by the United States. We haven't even got to the 20th yet.
I know.
We're still waiting for the inauguration of Donald Trump. We still don't know what exactly the details of that policy package are going to be. So we're waiting for all of this. Some people are front-running it, though. It's clear the Chinese have been getting out in advance. This huge trade surplus is something I suspect the new incoming White House administration is going to be paying a great deal of attention to. 992 billion is the number. Imports are stagnating. Exports are absolutely booming. We're up 21% on 2023. The PBOC is trying to stabilise the currency in advance of the dollar story that you've been talking about. All of this, again, just highlighting the world's vulnerability to this tariff trade, Lizzy.
Yeah, but could this be the peak? Is it downhill from here in terms of trade? As you say, exporters rushing to get the goods out of the door before Trump gets to the White House. But all eyes now on those parliamentary meetings in March. Do we get more stimulus then?
Are we going to need it before then, I think, is the question. Everything seems to be accelerating. Last week was absolutely amazing in terms of the market narrative and how much it's shifted. This week is set up for some incredible events in terms of the ability of those events to move markets. Let's talk about how those events are going to unfold. Laura Cooper's going to be joining us, Nuveen's global investment strategist. What is she looking for this week? Zachary Swabe from UBS Asset Management joining us to talk about European high yield. How is that having to reset? Helen, Jewell, BlackRock EMEA CIO for fundamental equities, will be joining us just after the open, talking about how she sees, there's a tongue twister there, isn't it, this week setting up. There's a lot going on this week, Lizzy.
Yeah, on Monday, today, we're going to get a speech from the UK Prime Minister Keir Starmer on AI, of course, trying to use it to grow the UK economy, just as Rachel Reeves was trying to do when she was out in China. On tomorrow, we've got the French policy agenda, French Prime Minister François Bayrou to lay out the new policy agenda to Parliament. Wednesday, key data out of the UK and the US on CPI. We also get, as I mentioned, those bank earnings, kicking off earnings season, JP Morgan, Citigroup, Goldman Sachs, Wells Fargo, BlackRock, and we'll get this confirmation hearing for Marco Rubio in the Senate. On Thursday, then, it's the US Treasury Secretary Scott Bessent's own confirmation hearing, as well as US retail sales and UK GDP. All eyes on that, given the market route here in the UK. And then on Friday, China GDP. So it's a very busy week to come.
Yeah, what are we going to be focusing on? What do you think the main event is? It feels like it's CPI right now. US data has clearly moved these markets in a big way. You get a hot print. How is the market set up for a hot print this week? Do we completely take off the table the idea that the Fed is going to be cutting?
Well, we just got the opening trade on the U.S. Treasuries as well. 479 is where we're kicking off the session this morning, already higher by about 3 basis points, almost 4. You said what's the main event? You said CPI. I'm going to argue that's actually the Rubio testimony. If we're front-running these trades, if we're front-running the tariff risk, if we're front-running the inflation, how much of that is validated come Wednesday in Congress?
Maybe. I think that'll be a factor. I'm looking to the UK data as well. I think that's going to be really interesting too. Clearly, Rachel Reeves has got a significant problem. Is the data going to confirm that the Bank of England is going to struggle to cut rates this year? If that is the case, that's only going to make life even more difficult for Rachel Reeves. Plus, China, the GDP number on Friday, 5%. How important is that going to be going forward? Can they continue to maintain that? What is happening in the Chinese economy? Absolutely pivotal. OK, let's turn our attention back to what is happening in more detail here in Europe. Let's go now to Bloomberg anchor David Inglis. He's joined us from the 18th Annual Asian Financial Forum in Hong Kong. David.
Good afternoon from Hong Kong, guys. Let me just chime in very quickly. I'm not sure we all have the emotional bandwidth for another hot CPI print following the jobs report on Friday. I'm opening a can of worms. We can get to that later on. Joining us here on set to talk us through all things rates, tariffs, I heard your conversation there, and where we go with the Fed, and also the ECB, of course, with a CPI print, of course, coming through this week. To your point, Olli Rehn joins us here on set. Of course, you guys might know him, of course, from you. It's very nice to see you, and good morning, good afternoon. Thank you for
good
joining.
Good afternoon and good morning to those.
Yeah, good evening too for those joining us in that part of the world. I was listening into your panel earlier on, and just to pick up and start off with a tariff conversation. I think you mentioned, and just to paraphrase it very simply, that Europe should not take these tariffs passively. What do you mean by that? Are you suggesting maybe Europe takes some retaliatory stance, a bit firmer stance ahead of any potential moves from Donald Trump?
What I mean is that a negotiated solution is by far better than any trade war, and of course Europe is not instigating any trade war here. But the essence is that Europe cannot be taken by surprise or caught off guard. Instead, it is important that Europe prepares potential policy measures in case there will be tariffs or other protectionist measures against Europe. The essence is that the last thing we need at this juncture is a trade war, especially between allies, as there is illegal, brutal war by Russia in Ukraine going on European soil.
It would be, and I would imagine it would be remiss of the ECB's duty not to game out worst case scenarios if we do get to that point. What would be the worst case scenarios if Donald Trump does up his game on tariffs, and how would the ECB respond in kind?
We've done some scenario work both at the European Central Bank and us at the Bank of Finland. But let's see how things evolve. We are soon not necessarily wiser, but perhaps at least more informed about US trade policies vis-à-vis China, vis-à-vis other North American countries, and also vis-à-vis Europe. Then we can better judge what kind of actions are needed. From the ECB point of view, the essence is that our mandate is price stability in the Eurozone, and we look at all policies and all actions in light of that criteria.
There was an uptick in inflation in December in the Eurozone, to your point. I think we get the final numbers in a couple of days. Does that affect, in your view, market expectations of the upcoming rate-setting meeting you guys have at the end of this month?
I think the numbers were quite expected, quite as expected concerning headline inflation and also core inflation, underlying inflation. Now we are heading to the January meeting in a few weeks, and the background is that the economic outlook in Europe is somewhat dualistic. We have both pluses and minuses. On the plus side, inflation is moving to the right direction in the sense that disinflation is on track, and we are quite confident that inflation is stabilizing at our 2% target. Employment is holding up, it's robust. On the minus side, the growth outlook has weakened, it's fairly subdued, and this prompted us to cut rates in December, which was the fourth rate cut in 6 months. And now the policy rates are down from 4% to 3% in the Eurozone.
And markets have a consensus currently that you will likely have to follow up with another rate cut, and not to, of course, commit you to that decision just yet weeks out, but suffice to say, without any external shock between now and then, would you be much open, of course, to another reduction at the end of the month?
I think against the backdrop of disinflation being on track and growth outlook having weakened, it makes sense to continue rate cuts. The direction is clear. The scale and speed of rate cuts depends on the incoming data and the comprehensive analysis we do on that data. In my view, we are likely to leave the restrictive territory at some point in the course of the coming spring-winter, which in my country can mean anything between January and June.
Okay.
So I would say that at the latest by midsummer we should have left the restrictive territory.
Okay, you open up a can of worms here on the conversation around neutral. Where do you think neutral is?
Neutral, or I would say the natural rate of interest, which is below neutral, minus inflation.
Right.
So it is a very useful and important analytical framework to think about monetary policy, but it is not a concrete policy-making tool. In my view, we see that the natural rate of interest is fairly low for the moment, but I would not want to put any figure at this stage because, as said, it is not. It's a non-observable moving target and better as an analytical framework than as a concrete policy-making tool.
I've heard a comment before for space geeks. It's almost like dark matter. You know it exists, but you don't know how to describe it. Let me ask you then. Two things recently have affected exchange rates. One is really where you are with the Fed, and it might look like they won't be able to cut more than once or twice this year. And of course, what that means with the currency, and you know that if the euro falls below parity, the media is going to over-obsess about it. Do those two things affect your rate decision mechanisms right now? How important are those two things?
The exchange rate is not a policy target for the European Central Bank. Our policy is based on our mandate, and that is price stability in the euro area. And of course, the exchange rate influences has an impact on inflation to some extent, and through this channel we take this development into account as it happens. But the European Central Bank is not the 13th federal district of the Federal Reserve System. We take decisions on the basis of our mandate, which is price stability in the euro area.
Right. What is, just looking ahead this year, what's a wild card for you? What do we have enough, what do we know is a big factor, but we don't have enough information on?
Well, we have at least two big factors. One is the geopolitical developments, both in Ukraine, the Russians' illegal war in Ukraine, the tragic events in the Middle East and the shift of power in the Middle East, and also tensions in the South China Sea. So we have plenty of concerns about the geopolitical developments, which is creating uncertainty, clouds of uncertainty above also the European economy. The other big issue is, of course, trade policy and what kind of tariffs or other trade measures the incoming U.S. administration under President-elect Trump will take. As regards trade policy, it's worth underlining that the European Union acts as a unified actor in this field. In other words, we have a community method in trade policy. We practice common trade policy, and that's an important backbone and protective shield for each and every 27 member states of the European Union.
Governor, it was great to see you in the region. Let's do this again next time you're back in town. Thank you so much. That was Olli Rehn, of course, Bank of Finland governor, joining us here at the 18th Asian Financial Forum here in Hong Kong. Guy, back to you.
David, very nice. Thank you very much indeed. David Inglis and Olli Rehn. Olli Rehn making it clear the outlook for growth has weakened and the direction, Lizzy, of rates is clear. Down.
Yeah, and it makes sense to continue cuts this month. The debate really being whether, first of all, they should go for jumbo moves. Lagarde, of course, mentioned that had been on the table in December, didn't rule it out in January. Rehn, to me, doesn't sound panicked there. You know, he's talking about inflation moving in the right direction, employment moving up. Doesn't sound like a man who's going to be voting for a jumbo move. And, of course, he is at the centre of the ECB spectrometer, really. The other big debate on the ECB Governing Council is where neutral lies. Nice that Dingle's dived into that can of worms. Interesting that Rehn's saying that they'll leave restrictive territory between spring and winter, latest midsummer. So that one, you know, really at the centre of the debate on the Governing Council.
I love that he said that this isn't the Fed's 13th district, which we appreciate that clarification. He also says, look, that you need to have a negotiated solution on tariffs better than a trade war, really trying to prevent one. Is that a moot point? Are we already further beyond that? We should just expect a trade war as our base case. That seems to be the consensus.
It's moving to the centre of the distribution of outcomes, isn't it, in terms of the narrative that we are working with. Earlier on, Philip Lane, the chief economist, was giving an interview to an Austrian newspaper. Need to ensure interest rates follow a middle path. That seems to take maybe that jumbo 50 basis point cut maybe off the table if you listen to what Philip Lane has to say. We are going to continue the conversation. We're also monitoring what is happening down at Cape Canaveral in Florida. Jeff Bezos' Blue Origin space team counting down to an inaugural launch of its new Glenn mission. You're looking at live pictures of the rocket. We keep pushing back the launch time. We're now 28 minutes away from that launch. When it happens, we will, of course, bring it to you live. This, of course, is Bloomberg.
We are 37 minutes away from the opening trade. Risk sentiment is down in Europe. You're looking at the futures picture down, seeing some 0.6% drop in those stocks futures. We'll see how we get as we get closer to the open. But really, it all comes down to how you're positioning for what is down to be a pretty volatile year. Let's get a deeper dive with Laura Cooper, global investment strategist over at Nuveen. Welcome to the set. Good morning. Let's kick it off with some of this Fed pricing, because, of course, that is what some people think is the core of all of this. On Friday, when you look at kind of this major move from the payroll story, I was surprised to see a little bit of a sell-off. And I'm curious, for the next leg of gains in any risk asset, how badly do they need a Fed cut?
I don't think necessarily we need to see risk assets have that Fed cut. I think what's crucially going to be kind of contingent on the data that we have. So if we look at inflation is really that key data point this week, I think the market narrative, the risk is that it shifts towards rate hikes rather than an extended pause. I think the bar for hikes is exceptionally high. In our mind, it's really a question of how much can this U.S. growth exceptionalism persist against a backdrop where yields are climbing, potentially testing that 5%.
A cut to tail risk now?
I mean, I think at this juncture, given the fact that we did see such a robust payrolls report, does suggest that in the near term, a cut is a tail risk. If we look to January, I think March is a bit of an open question. We'll have much more clarity in terms of the policy front after the new administration. Perhaps then we start to see some cracks in the data. Then rate cuts will start to come back on the table. And that is our base case, that we could see the Fed cut, let's say, 2 times this year. And it's one of the reasons why we're actually positioning now in short duration exposures rather than taking on that long end, given the risks around really just this rising term premium potentially persisting.
But when do you start to panic? If you've got 5% on the 10-year yield, maybe not for you. But if you get to 6%, if we head towards 6%, when do you start to flee stocks?
I think it's really what matters is what's driving that rise in yields. If we think about, if it's largely predicated on economic strength, then perhaps that's not as a negative. But what we're seeing is a confluence of factors. So the rising term premium now above 60%, 60 basis points on the 10-year. We have this disinflationary progress now stalling. And I think that's going to be, the greater market narrative. So the market can withstand potentially 5% 10-year, but that's because of those valuations. We're likely going to see investors buy that dip, and that in turn could see kind of this positive stock bond correlation flip negative. Once again, bonds are kind of that haven property, and then that should ease some of the financial conditions that are kind of restricting stock performance, at least what we've seen since the start of the year.
You made a crucial point there that the 5% is something people are already getting prepared for, arguably even pricing for. We're only about, I'm doing some quick math here, 22 basis points away from that threshold. I'm going to put you on the spot here. What is the ceiling on 10-year yields in this leg?
I mean, I think we're still of the view that it's going to be very choppy price action with the Fed essentially on the sidelines until March. It's going to be driven by economic data. It's going to be driven by policy. So there is a risk if we see a hotter than expected inflation print this week, we could start to see that 5% being tested. I struggle to see just a rate above that being sustained, because if we start to think about where U.S. mortgage rates are, if we start to think about kind of the consumer spending backdrop is going to be challenged, I think that's where we're going to have bonds come into play.
Well, certainly something going to have ripple effects. Laura Cooper, she's not going anywhere. Global investment strategist Nuveen is sticking with us. We're going to be talking about the ripple effects in the stock market, the bond market, of course, the credit markets as well. Stick with us. This is Bloomberg. 30 minutes away from the start of the opening trade, you are seeing risk sentiment continue to spiral when you look at the futures picture. Perhaps a little bit of that market reaction coming in from the States on Friday. Your Stocks 50 futures are down about 0.6%. The CAC 40 and even S&P futures down, I'm going to say, by about the same margin, almost about 0.5%. Risk sentiment is certainly suffering across the board. You're seeing a similar story in some of the cross-asset picture, which brings us right to the bond market as well, because we are seeing U.S. Treasuries open at 479 about 30 minutes ago. That already having a ripple effect into those European yields. The German 10-year higher by about 2 basis points. The French 10-year, we'll call it 3 basis points. And a similar story for the Italian 10-year as well. As promised, Laura Cooper is back with us, global investment strategist at Nuveen. We couldn't let her go just yet. We were talking before the break a little bit about the Fed story and how you kind of priced that in as well. The other factor has to be Donald Trump, of course. And it feels like so much of the expectation and the inclination to price in higher interest rates in the future is coming from this tariff perspective. But we don't even have the details yet. Is the market creating a dislocation for itself?
I think the market is struggling to kind of price in what those potential policies could be. We do have some signs of what is likely to come through. I think key focus for investors, though, before we get to that 20th deadline, will really be looking at the earnings kickoff that we have. So right now, a lot of that potential pessimism around policy uncertainty doesn't appear to be priced into earnings expectations. You know, it's elevated above historical averages. Yes, a lot of that in the U.S. is driven by the tech sector, which is expected to have that 20% plus gains. But I think it's going to be about dispersion across sectors and seeing more of that rotation towards that big tech trades that I think is going to be really in focus before we get to that deadline.
Well, yeah, we got all the banks this week. Where are you looking for the cracks in the bull thesis there?
I think when it comes to banks, you know, we are potentially looking at what they see from a 2025 outlook perspective now that rate cuts are largely off the table, barring, you know, one or two. And so how that could impact loan growth. But I think broadly, it's going to be a story around, you know, which sectors can continue to outperform it. Are we going to see more of that tech leadership, or are we going to see some of those smaller companies start to catch up? I think in the near term, that is potentially a risk given the inflation print. But more broadly, we do still think, at least in the near term, this U.S. exceptionalism can persist and support that broader rotation.
So I want to put money to work in the UK right now.
I mean, we have certainly been long gilts. I think it's been a challenging trade. I think it's the challenge has been this is kind of trading in tandem with U.S. Treasuries. Sure. And then you overlay the fiscal concerns around that. I think in the near term, it's quite cautious, kind of take on that long duration bet. We're really watching for data-driven rallies to kind of become a little bit more kind of into that trade, and as well watching for an overall shift in that bearish sentiment coming from Treasuries. I think the fiscal concerns, looking at OBR sensitivities, it's going to be a challenging backdrop. We need to see greater fiscal clarity.
The Treasuries are driving everything.
I think at this point, yes, we aren't seeing that disorderly kind of price action in the UK.
In terms, I just want to ask you one more question. In terms of the overall picture, how should investors be approaching this year from a diversification point of view? Iqbal Khan was on a little bit earlier on from UBS, talking about the fact that it's so important to be diversified this year. What is an uncorrelated asset right now?
It's a great question. I mean, I really think it depends on your time horizon. We're looking at real assets like infrastructure. That is kind of one that we're positioning for, and the potential inflationary resumption risk. I think as well, this U.S. exceptionalism story will persist. But a lot of that negative trade news is largely in the price, looking at some European sectors. So perhaps you want to take on more of those exposures. And of course, we're talking about this higher for longer yield backdrop. Income remains quite appealing in terms of broader fixed income.
And you're getting some of that in credit. Laura, nice to see you. Thank you very much indeed for stopping by to see us. Laura Cooper, Global Investment Strategist, joining us from Nuveen. OK, let's talk about where that income could come from. Zachary Swabe, European high-yield portfolio manager at UBS Asset Management, joining us around the table as well. Good morning.
Good morning.
Treasury yields at 5%. What does it mean for your market?
Sure. Treasury yields at 5% gives a little bit of flexibility to our mandate. So if we think about it, high yields, steeper curves, we actually can buy in at better yields. That's in Europe, in the gilt markets, so sterling credit, European credit, and US credit. So we're buying 10-year, significantly wider than we were 2-3 months ago. If we think about it in the broader economic context, is this a tightening of financial conditions? Are we seeing that yet in the data? Not really. So you've got positives and negatives with the high yield jump over the last kind of 2 months.
In terms of what you're expecting to see over the next few months, more downgrades than upgrades? Is that the kind of narrative we're looking at?
I think the upgrade cycle is still quite in health. So we've had a multi-year upgrade cycle in corporates and in banks in Europe and the US, and that still looks like to be in place. You know, the risks of the tariffs and the trade war 2.0, really yet to see that. If the Section 231 starts in, I think, April, May, when we start to see the results of that, or the findings in the retaliatory tariffs, we're not going to see the fundamental deterioration really until, you know, the back end or maybe Q3, Q4 reporting. A lot might be in the price, but the fundamental reporting and what we could see in a deterioration of sectors, autos, chems, won't come till then probably.
We keep waiting for some sort of default rise or default jump as well, and we continue to keep kicking that can down the road. Is there a concern about zombification still, or is that kind of a 2022 theme?
Yeah, zombification is something we've spoken about a lot over the years, and we do see it in the market, certainly. So if we look at historical default rates, we're used to in the global credit markets, a high yield running at 3-4%, for example, in the US and maybe a bit inside in Europe. Right now, 2024 default rates in high yield were quite low, 2.5%. But this year, we're forecasting extremely low default rates, 1.5%. So there is zombification. What's going on underneath the hood? So we're actually having a risk transfer from public markets to private markets.
Yeah.
So all the defaults, all the bad companies haven't left for the economy. They've simply been shifted to the public markets, private credit, direct lending.
Yeah.
So public markets now on a spread basis, they're trading quite low. But obviously one of the main factors for that obvious is this shift of risk of bad companies, these triple Cs, these over-levered PIK deals moving to private markets, which benefits, obviously, you know, myself talking to clients, talking and trying to raise assets.
That sounds like a very, very scary dynamic. And then on top of that, you have to talk about the interest rate pressure as well. Zachary, we had a conversation last week with the vice president of MEDEF, of course, one of the major trade lobbies that represents a lot of the French businesses as well. I just want to play you a little bit of what he said about the refinancing rates.
If the price of stability is to come back on the pension reform, that's a no. The debt is 12%. It's enormous. And the cost of this debt could go up to 70 billion a year. So it's all this money that we need for something else, to invest in the future, in innovation. We don't have the luxury to burn our money just to pay high interest rate because we don't do the job of reforming the countries.
Fabrice Lessachet, the vice president of MEDEF, they're talking about $70 billion, billion euros, excuse me, that have to go just to refinancing alone that can't be deployed elsewhere. Is that the right amount to you, 70 billion euros?
So this was, I couldn't completely hear, that was in relation to...
This was in relation to, of course, the interest rate picture from France as well. But you're seeing this around the world, right? This interest rate jump in the US, in the UK, in France. How much of that extra money should be going towards growth goes towards refinancing?
Yeah. Well, I think we could think about it, and again, what's the effect on financial conditions, on companies? So within the economy, the shift between the fiscal, or if you're paying loan payments, might not actually matter if it stays within the domestic economy of France. If we think about 2022, you know, rates went from negative 0.5% to 2%. So we had a jump of, let's say, in Europe, 250 basis points. Companies dealt with this quite well. You know, we came out the fundamental picture okay, interest ratios are okay. So the jump we're seeing at the moment due to higher French borrowing costs, you know, oats over bunds, actually might be absorbed reasonably well because we've already had the precedent of the 22 jump. Companies accepting it, moving on, and actually recalibrating along with rating agencies, you know, what the fair value of their credit spread should be, and also their ratings, whether it's, you know, triple B or single B, for example.
In the UK example, though, how worried should we be about the housing market when it comes to the rate story? You know, if you're seeing fewer Bank of England rate cuts priced, and you've got these higher gilt yields already feeding into the mortgage market, when do you start to panic here?
Yeah, I think it's a similar story, Lizzy, to the jump we've seen in funding rates for mortgages again in 22. It was even more aggressive in the UK. It went from 0 to 4, so it was a jump in mortgage rates. Defaults ticked up a little bit in the lower cohort of borrowers, but actually it's not that bad for financial conditions. The consumer's been, to be honest, been weak since Brexit in the UK. We've been growing very poorly. Supermarkets have been in extreme competition, and so have the banks on their mortgage rates. So the actual net effect probably isn't that significant for the recent jump in gilt yields. Transaction volumes might slow a little bit, prices might calm down, but to be honest, every time we hear about the Halifax or the nationwide housing price survey, they're always different, and whether it's London or looking at the north. So lots of data to go through there, I think. OK,
so less worrying because it's on the slow burn. While we've got you, let me just also ask you about China, because, you know, we've had all of this data this morning. I wonder, with the expected stimulus on the horizon, are you more optimistic about commodities companies there?
Yeah. So the Asian commodities companies are trading quite mixed spreads, but still quite in the low end, you know, the low 200s, for example. A large, massive China stimulus, you know, will help in theory, you know, the base commodities, might help some of the more special commodities. It's difficult to say. We've been waiting for the large R cut. Can it happen? It would be great for, obviously, the Chinese property market and therefore the wider economy. Let's see what the effect would be.
Let's see, indeed. Zachary Swabe, high-yield portfolio manager at UBS Asset Management. Good to have you with us around the table this morning. Coming up on the opening trade, as oil prices soar, we're going to look at the read-across for equities at the open. Energy and airlines also in focus. These and your other stocks to watch. So do stay with us. This is Bloomberg. 16 minutes away from the opening trade. Futures pointing a miserable picture here in Europe. Eurostoxx 50 futures down 0.6% currently, and it's red across the screen as we get towards the opening trade for the week. But let's get to some news that's going to annoy Donald Trump. China's trade surplus reaching a record just shy of $1 trillion in 2024, driven by record exports and weak imports. And those moves, of course, coming ahead of potential trade wins for the country, with the president-elect's return to the White House just a week away. Joining us now to break down that data is Bloomberg's James Mager, joining us from Beijing. James, just talk us through the drivers of this huge increase in exports and the surplus.
Well, the first thing that's driving this huge surplus really is the weak Chinese economy. They're just not, I mean, imports were basically flat on year from 2023. And so, you know, China's not buying as much as they would otherwise normally be buying. And also commodity prices are falling because Chinese demand is so weak. That's one of the factors. Obviously, the other factor is a massive increase in exports. Exports last year were $3.6 trillion. And, you know, that is just a huge jump, driven by a number of factors. One is obviously companies are desperate to get as many goods as they can onshore in the US before Donald Trump comes back to the White House. And you know, if he does what he says he's going to do, impose 10% tariffs on Chinese goods on the first day, and probably ramp those up later, you know, depending on what happens with negotiations with the Chinese. So one factor is, you know, US companies trying to get ahead of tariffs. Another factor is, you know, Chinese is exporting a lot more goods, and Chinese goods are a lot cheaper. They're exporting to Africa, they're exporting to ASEAN. You know, part of that demand from ASEAN is goods that are going to Vietnam. You know, parts are going to Vietnam being made into an iPhone or being made into, you know, a computer and then being sent onto the US. But part of it is just demand for, you know, good, cheap Chinese products. European demand is also rising. You know, as European trade surplus, China's trade surplus with Europe was at a record again. So, you know, there's a lot of different factors. Part of it is the US, but part of it is just, you know, that China is now the world's manufacturing, or the center of manufacturing for the whole world. And, you know, the global economy is doing okay, and people want Chinese stuff.
Joe, if we're trying to get in advance of out in advance of the tariffs, do we get? Is it possible to get a handle on how much of this front running is pulled forward, and therefore what the drop will look like later?
You know, I think if you're looking at the US, data, US imports are rising much faster than European imports are, for example. So I think if you were to subtract that and just assume that they should be growing at about the same pace, you would probably give you a reasonable idea about how much of that is front-running tariffs and how much of that is just strong demand. And I think the gap was, you know, about 10 percentage points of growth in December, for example. So, you know, looking forward to this year, we're about to go into the Chinese Lunar New Year. That's starting in about 10 days. And so shipments are going to slump over that period. So late January, early February, there's going to be a big slump in Chinese exports. And then obviously Donald Trump will be back in the White House at that point, and we'll see what happens after that. But, you know, I would expect that there is going to be a pullback from both of those factors in the first quarter, just because people will have bought all the things they need to, or much of the things they need to, and then there is that Chinese holiday, and then people are going to wait and see what happens with tariffs. If Trump comes in and only imposes 10% tariffs on all Chinese goods and does nothing else and says nothing else, I think people might assume that's how it's going to be going forward, and they might go back to more normal purchasing.
All right, Bloomberg's James Mager, thank you so much. Walking us through, of course, the impact on that front-running of Donald Trump, already seeing it in the Chinese data as well. We'll see it if we see it in other pieces, certainly something that's being priced into the bond market. Let's get a little bit more analysis on that front. Joining us now is our Markets Live executive editor, Mark Cudmore. Mark, we were just talking to James as well about just kind of that front-running element. In the meantime, we've already seen a headline crossing the Bloomberg terminal that the Indian rupee is sliding the most since 2023 versus the dollar. A lot of that being the knock-on effect, of course, of what we saw on Friday's payrolls numbers. How much of that dollar surge is going to overshadow the growth story, the positive growth story from a lot of these EM countries, not just in India, China, but perhaps in Latin America as well?
It's definitely an issue, and particularly right now, especially when you mention India, in context of the oil price surge to a month-to-month high. Remember, when you get oil priced in dollars at a multi-month high, the consequence, and the dollar is at a multi-year high, the consequences for other currencies are quite dramatic. India is a major commodity importer, so it made sense today that rupee suffered particularly badly, given that those oil price moves and given the backdrop of a strong dollar, higher US yields anyways, because of the US data. So I think that is a worrying threat to the EM sector out there. However, it depends on whether you think that this dollar move continues. Remember, we've priced in an exceptional amount of dollar strength over the last few months in anticipation of what Trump might deliver. I kind of feel that the dollar is pricing in many of the potential benefits from potential Trump policies and not so many of the negatives. And I actually think we're getting towards a point where the dollar is probably reaching its zenith. We're probably not quite there yet. I wouldn't want to fade it just yet, but I think we're getting towards a point where dollar has more downside than upside.
Mark, you've just come back from a well-deserved break. How much has changed in the meantime while you've been out? How different do the views look on the backside of the holiday?
Yeah, it's a great question. I'd say that in the bigger picture, not much, because it all depends on what Trump ultimately delivers, and we don't have loads of clarity yet. We're getting closer to getting that clarity, but, you know, that is really going to decide everything that's priced out there. I think away from that big headline macro stuff, it's really notable the deterioration in mood in the UK, really completely dramatic, and just, it is very new, but obviously these oil price moves and the latest sanctions from the US on Russia that are really much more impactful than the prior ones make a big difference. And I think the fact that China negativity is really continuing is really notable. So I'd say it's away from the biggest story, and the biggest story is still what Trump delivers, which we don't know yet what that will be.
Well, Mark, you mentioned the pound. Do the moves we've already seen on cable in the Asian session suggest there's worse to come this week?
I think, unfortunately, the mood around the pound does remain extremely negative. Talking to everyone, they see either way inflation prints as being a negative catalyst for the currency. I think we're probably reaching quite an extreme in terms of the sentiment. I think, you know, we had a bout of bashing the yen against the dollar, then we bashed the euro, then we bashed the Aussie, then we picked sterling. I think, you know, sterling has probably done its shift pretty soon. But again, we may have to wait till after the inflation data this week. Maybe that will be the turning point for people to realise that why is the pound getting particularly picked on? It doesn't have worse growth, worse debt dynamics than many other countries out there.
All right, key inflation data out of the UK and the US this week. Bloomberg Markets Live executive editor Mark Cudmore, we thank you. Remember, you can get all the up-to-date analysis and insight from Mark and his team by going to MLIV Go on your terminal. Now, let's go to the stocks to watch with Joe Easton from our Equities team. Joe.
Morning, Lizzy. So we're going to be watching the energy stocks and also airlines today following this big two-day rise in crude oil that we have seen. Crude at one point was on course for its biggest two-day gain since February last year. We can see it up almost 5%, around 5%, just above on a two-day basis. So keep an eye on the main energy stocks, particularly here in London, like Shell and BP, also Total Energies, Eni, the kind of major oil companies that we tend to look at on days like this. And then the airlines, of course, given the expected increase that we might see in fuel costs and the focus on hedging, how well hedged these airlines are on the oil price at the moment. So IAG, Lufthansa, also EasyJet, Ryanair wants to watch today. Then in terms of pharma, we've got Sobi, the biotech company over in Sweden, about a 10 billion market cap. They have got some better than expected sales guidance on some of their orphan drugs. So it's a rare drug maker. We can see that stock having a decent run over the past couple of years, and it is well liked in terms of analyst ratings. Only one sell, 12 buys on that one. Then in the M&A space on banking, We're keeping an eye on BPM, BAMI. That's after news that the Italian government potentially going to be reviewing conditions on any eventual takeover by UniCredit. Now, remember, UniCredit did make a proposal for that firm last year. We can see it up around 70% almost on a one-year basis. So potentially, maybe this might mean some uncertainty around that deal going through. So we're going to keep an eye on that one in Italy today. Then on your ratings, lots more coming out. Firstly, JP Morgan, this one caught my eye. They say buy the dip in Sainsbury and Tesco after the sell-off in the UK macro situation last week. Richemont, meanwhile, in luxury, that's a buy at TD Cowen. And just hitting the wires a few moments ago, BBVA is a top pick at Bank of America today. They also like SocGen. Big note on banks. BBVA potentially going to be higher in Madrid this morning.
Certainly one we're going to be keeping a very, very close eye on. Joe Easton, we thank you so much for walking us through, of course, stocks to watch. 7 minutes, 6 minutes time now until the opening trade. There's a lot to digest here in terms of some of these markets as well. We are, I should mention, also still awaiting this rocket launch that we are expected to get at some point. The launch time
21 minutes now.
21 minutes.
Feels like that all morning, though. It keeps getting pushed back.
Of our seats, absolutely. But, I mean, I think it's going to be interesting. We talk about China. We talk about the dollar story, the Fed story. There's a little bit of tech in there as well, if you look closely. All of that likely to move the market this morning.
The market's got to deal with Friday still. Europe hasn't yet fully factored all of that in. So that's something that we've got to think about as well. And looking forward into this week, how much risk do you really want to take? So many risk events littering the agenda this week. So many potential banana skins for the market to trip on. It's absolutely incredible to watch what could... It will be absolutely incredible to watch what actually doesn't. You've got claims, you've got CPI, you've got PPI, you've got data out of the UK, you've got all kinds of things going on. And then, of course, we haven't even factored onto the agenda a few Trump tweets here and there. Maybe that will blow things off course a little bit as well.
I'm sure we'll get a little bit of that as well. At the moment, the risk sentiment is broadly lower. And already, even though you are seeing some of the commodity space actually higher this morning, Brent crude, as of course Guy mentioned earlier, almost near an 81 handle. Futures remain significantly lower. We're a few minutes away from the opening trade. This is Bloomberg.
Monday the 13th, good morning. Have you blocked Friday from your memory? The payroll number, the blowout figure, the good news is bad news narrative. That feels like last week. This week we've got so much to think about, but the continuation obviously is going to be really relevant for asset managers and how they think about how they position themselves. This was the picture Friday. We actually priced some of it into Europe, so you've got to think that that's already in the price. But US futures are lower. US bond yields are higher once again. So we've still got all of that to think about. So yes, we did see a little bounce off the lows in the United States Friday afternoon, but it doesn't feel like it's going to stick this morning, Lizzy.
No, Eurostoxx 50 futures, Guy, have not forgotten about Friday. That US jobs report, as you mentioned, futures pointing lower 0.6%. It's not such a bad picture on the FTSE 100 because you have seen the pound taking this leg lower already this morning, and traders expecting it to go even worse. So the mechanical effects helping the FTSE 100, but keep an eye on the FTSE 250 at the open. CAC futures still factoring in this political uncertainty. Of course, we hear from the new Prime Minister Behu tomorrow, but for now, that's uncertainty continuing. But what's going on when we come to individual stocks, Kriti?
Yeah, a lot of thematic moves, I think. A lot of the stories that we've been talking about since this morning, the idea of broader sanctions, for example, on Russia having a ripple effect into China, into India, that might be reflected in some of the markets as well. The latest sanctions roundup out of the States coming that impacts more than a quarter of Russia's seaborne oil exports, as well as vital insurers and traders. Hundreds of cargoes at play. That might likely show up as well. Not to mention the export data we got out of China, really front-running the potential trade tariff that's showing up in the shipping space. And then BBVA, a favorite stock of mine as well, is getting an upgrade over at Bank of America, Guy.
OK, let's talk about how this market is going to open this Monday morning. We're expecting the FTSE to outperform. FTSE's got a lot of oil stocks, doesn't it? Maybe that's going to be one of the reasons we're going to watch that story so carefully. So here we go. Let's show you some numbers. Let's get an idea of what is happening here. FTSE's already out of the gate. It's a little softer, but not by much. We're down we're flirting with the flat line. We really don't have a clear sense of direction here. There you go. We pop positive on the FTSE 100. Will oil stocks outperform today on this sharply higher oil prices? Gas prices, by the way, are also sharply higher this morning. Think about that when you think about the inflation number we're going to see out of the UK a little bit later on this week. Energy prices are becoming a problem once again for the inflation story. The 600's out. We're down by 0.4%. The CAC is a little bit lower as well. We're down by 0.3% there. The IBEX, to Kriti's point, down around 0.5% this morning. So European stocks already looking at the narrative around the world, thinking about the week in advance, trying to work out what we are going to be seeing as we work our way towards Friday. There are so many banana skins between now and then for portfolio managers. You must be feeling pretty nervous out there right now. Kriti, let's talk about the sector story. What's going on?
Well, if you're an oil bull, today is a day to smile a little bit because, as you said, Guy, that's exactly where you're seeing the outperformance among a sea of red as well. I mean, look at that Rick's sentiment, just a blinding image. But when you look at kind of the individual movers there, the index contributors to the upside come from exactly the places you just mentioned, Guy. Shell, BP, Total, you name it. Even some of the banking story as well. If you are expecting some of the ideas of kind of higher interest rates as well, the banking sector is going to be very much in focus. BBVA, Lloyd's, for example. I'm seeing a little bit of HSBC on the downside, though. But the China story is peeping through. The energy story is peeping through. The tech story, not so much. That's actually driving some of the downside gains. ASML, among others, really on the back foot this morning.
Yeah, technology, bottom of the basket this morning, down 0.9%. Joe Easton told us that we should be minding the airlines, given the oil price moves this morning. And indeed, you've got IAG, Deutsche, Lufthansa, EasyJet, all in the red. In fact, IAG suffering the most of those three names, down 1.4%. But it's energy, top of the basket, the only one eking out gains when it comes to the sectoral picture, up more than 1%.
Gilts. So you talk about gilts. We talk about 5% in gilts. We talk about that number. We are currently now trading at 4.899 on a UK 10-year. We're up by another 6 basis points this morning. Just kind of factor that into your thinking when you look at how this week is likely to progress. You are continuing to see that focus on what is happening here in the UK. The Chancellor, Rachel Reeves, is back. She's back from China, as is the Governor of the Bank of England. I just want to kind of point that one out as well. So US 10 years are up by 2.7 basis points. Gilts are up by 6.1% this morning. So we are seeing maybe a continuation, Lizzy, of that trade.
Well, you know, there was this question of whether Reeves should have gone to Beijing at all, but should she have done more over the weekend to calm this market? She wanted to take the high road and talk about the long-term investment picture with China, but talking about her commitment to the fiscal rules doesn't seem to have been enough here to calm the gilt market over the weekend. And as you say, yields taking a leg higher again this morning.
Yeah, 6 basis points on that 10-year yield. But you are seeing, of course, yields higher around the world as well. The move continues on the upside in the likes of Spain, Italy, and France. Not to mention a little bit of Germany as well. That is a global story. Let's bring in a true expert on how you navigate this environment. Helen, Jewell, CIO for Fundamental Equities over at EMEA at BlackRock, joins us this morning. We're talking a lot about the bond market, talking a lot about refinancing as well. How do these surges that you're seeing, at least in the last couple of days, certainly in the last couple of weeks, on the long end of the curve, hurt or help the case for equities?
Yeah, I mean, it's a great question, and it really has been a very nervous start to the year. It's amazing to think we're only 7-8 business days into this year already. In terms of how it hurts or helps the equity market, that 5% threshold that Guy referred to is the pain threshold. It's always been that mental pain threshold. And what we are seeing is almost every day, we're seeing kind of moves in different stocks, depending on the news of the day. But the long term is that the market is really in a wait and see. And the thing that will drive the market is how much the interest rates start to impact any of those earnings numbers that we start to see coming through. And that is the thing that is just not clear yet for the market. And that's why I think the market is reacting so much to any piece of news at any given point in time. The multiple is constantly reacting, both to the risk-free rate itself and to the nervousness and the equity premium around that. But what is still feeling pretty robust is the earnings number. Earnings growth is still looking pretty good. And if that starts to feel that it's easing, that is when you're going to see the real pain come through in the equity market. And we haven't got to that point just yet. But if we do start to see that coming through, that's when I would be very concerned from an equities perspective.
Well, so much of the kind of equities perspective we've been talking about has to do around positioning around tariffs, positioning around, to your point, the monetary policy that's baked into it as well. But from a fundamental perspective, if you look in the States and arguably in the biggest players in Europe as well, they're still hiring. They're still expanding. They're still investing in their CapEx in a really big way. why would you sell shares of those stocks on both sides of the Atlantic if they're still expanding? I understand the repricing narrative, but doesn't that just create a dislocation in the equity market?
Yeah, no, exactly. And that's exactly what we're seeing coming through. Now, the thing that is kind of almost interesting around this is you've got two things going on. One is this idea that everybody does need to diversify their portfolios. They need to diversify a little bit away from the US, especially when you're on a 23 times multiple over there. But on the other hand, the high-quality companies, both in Europe and in the US, which are generally the ones that have been more expensive, are the ones that are the most protected, possibly, from any tariffs that start coming through. And therefore, diversifying away from them doesn't necessarily make sense. And that's why people are nervous to do so, even though, from a portfolio construction, it doesn't make sense to be totally overweight these kind of names. So I think, again, what you're seeing is a real wait and see in the market. Wait and see. OK, we know that in theory we should be moving away from these names, but we're not going to do so until we see a little bit more certainty about what the plans are going to be. And that maybe will come in the next couple of weeks, but maybe it will take longer than that to come through. And therefore, we probably have to expect a little bit more of this volatility. And that's why simply earnings that we see this year are unlikely to be the 25% S&P that we saw last year. And I think that's probably very much a consensus view. Equities will remain positive and strong, but not the level of returns that we saw in the last 12, 24 months.
When you think about diversified portfolios, they have underperformed.
Yeah.
Does that change this year? Am I safer in a diversified portfolio than I was last year and the year before?
So that, I would say, is the biggest single question that is happening at the moment, particularly whether you say you do that very simply, diversifying away from the US, or whether you do diversification from a large cap to small cap. What we're definitely seeing from an investing perspective is people are nervous about being very underweight anything. If you were very underweight China, it hurt. If you were very underweight Germany, it hurt. So portfolios have definitely become more balanced. However, to go very overweight one particular area, we're not seeing many people doing that. Why? Again, because the quality play is the single biggest play that people feel pretty confident is going to be OK this year. So I'm not sure is the answer to that question.
Fair enough. What is the beta, though, within that diversified portfolio to the S&P? If the S&P drops, does Europe... I keep asking this question. Does Europe go down 5% or 15%? That's the bit that I also can't figure out is how does the rest of the world react if we get a drawdown at 5-6% on a US 10-year in the S&P? What happens around that?
Yeah, I mean, I think that if the S&P drops, the rest of the world drops by more. Okay. That doesn't necessarily mean, however, that's very, very different from saying you think the rest of the world might outperform the S&P. You could well see a situation that the S&P is up, let's say, 4-5%, and the rest of the world is up 6-7%. Sure. That's a very different outcome. But if the S&P is down because we are seeing treasuries up more than 5%, that pain threshold is hit, inflation stickiness, nervousness about the US, it's very difficult to see how the rest of the world doesn't react more around that, more negatively. But those two things are very different. Always so important to remember what drives returns, the multiple and the earnings. Yep. I do think that you will see the valuation gap start to narrow a little bit, i.e. you will see the US valuation or the multiple be slightly lower than it is now, and maybe Europe edging up or remaining constant. Yep. But those earnings in the US are so good and so strong. I mean, they're still at 14% predicted versus 7% in Europe. They might edge down a little bit, but I can't see them converging.
I get, Helen, that there's this focus on earnings over the politics, but how long can you ignore the politics? There's this great chart we have of the CAC's underperformance, the biggest in over a decade, amid the political turmoil there. When you say waiting and seeing, in France particularly, how long can you ignore the politics?
So you could ignore the politics for as long as interest rates don't get so high that you start to think that they're really going to have an impact on those earnings. The other thing that you also have to look at, and we haven't talked about, is the dollar. And the dollar strength is really important, particularly for European names. You've got two parts going on there. The first is you have the European exporters, which benefit basically from a strong US dollar. But on the other hand, what a strong US dollar does is it stops those US investors bringing flows into Europe because they get nervous about their exit rate. And what you really need in order to see Europe take a big leg up is you need the rest of the world, particularly the US investors, to start coming back into Europe. And a strong US dollar might hamper that. So I'll never say ignore, I'm never going to say ignore politics, but the German political situation for Europe is probably the most important one right now. Stabilisation in Germany will be really positive, I think, for Europe as a whole. So that is the one that I think is the most important. Having said that, if you do see some blow-up somewhere, that would not be good. But generally, I think, never say ignore politics, but it's not the thing that plays most on my mind right now. Inflation is what plays most on my mind right now.
Yeah, but that currency story really feeding into the FTSE story at the moment. We were talking about Rachel Reeves in China over the weekend. You've been bullish on Britain for a while now. Do you still feel that way, given it seems like Labour's plan seems to be crumbling a little bit?
Yeah. I think the valuations mean I still do remain bullish on the UK, particularly on those large cap names. 10 times is still very low, edging up a bit towards 11 versus more 13.5 and those very high US valuations. What we do need to see is some form of kind of calmness from the Bank of England. You know, we don't necessarily need to see them go out with kind of big statements, but just kind of this, we have this in control, we know where we are on things, we're not going to do anything knee-jerk, no knee-jerk reactions, either in terms of making sure that rates kind of come down or indeed any statements the other way. Just a kind of sense of calmness, I think, will really, really help external investors and how they perceive the UK. So less bullish. I don't think anybody is super bullish on anything right now. There's definitely a nervousness, but certainly still an area because of the valuations where we think it's important that you don't ignore it.
After last week, a sense of calmness sounds delightful. I think at the end of this week, it might sound even more delightful. Nice to see you.
Always great to be here.
Thank you very much indeed for stopping by. Helen Jewell, CIO for Fundamental Equity EMEA Research, joining us from BlackRock. The Core 6 looks like this. This is how we are looking right now across Europe. As you can see, there's a significant amount of green there. There are no oil stocks on that board, but it's interesting that Nestle may be holding up a little bit better. It's interesting also we have seen apparently this rocket launch being scrubbed. So we'll come back to that a little bit later and try and understand exactly what has happened there. We'll come back to the news. We'll figure out what the stock story is. Joe Easton has even more of it.
So we are seeing some moves higher in the energy stocks today, Guy, particularly here in London. We're seeing Shell and BP outperforming at the moment, given the focus on the crude price and the sanction story at the moment in terms of between the US and Russia. So that feeding through also into Total Energies in Paris and Eni in Italy as well. And then going the other way, as expected, we're seeing some weakness in airlines, of course, a massive consumer of oil given the jet fuel outlook, and we'll look to see how well hedged these companies are against these price rises. But we can see a pretty decent move lower in Air France and also the other big names, Ryanair getting hit down 1.3%. All of the stocks moving lower on those oil price moves for the airlines. Then in terms of recruiters, we had another update from Page Group. Now, the UK-listed company actually warning of weakness in France and Germany in particular. They say those are the markets that are now seeing some weakness. I expect the UK outlook not too strong either, but at the moment they are looking at their European markets in terms of some weakness, therefore seeing some feed through into Hayes, Adecco, couple of others like Randstad. Then we got a big move in Entain. Now remember, Flutter a couple of weeks ago or even last week warned of weakness in the US due to some adverse results in the NFL betting markets of people winning more money, and that hit Entain. But Entain today reiterating their guidance and therefore quelling some of those concerns, and that stock gaining almost 9% at the moment, a decent rebound for Entain, the Labrix owner at the moment. Then on your ratings, BBVA, as we said earlier, this one up to buy at Bank of America. Now, interestingly, they point to the Turkish exposure. Remember, BBVA owns a big stake in Garanti Bank, and they reckon Garanti is doing better than expected, so they like that one. And then going the other way, Goldman Sachs is downgrading DWS. This is, of course, the big asset manager over in Germany, and getting hit down 3.7%. Goldman goes to neutral on that. They upgraded it around a year ago. It's had a little bit of a rebound recently. They think that's overdone. And that one, DWS, sliding 3.7% on the German market.
All right, Joe Easton from our equities team, we thank you for that update. Just also looking at some interesting moves here on SBB. Those shares are currently higher 8%, 8.4%, but they have been up more than 10%. This off the back of the Redhead crossing the terminal. The SBB says Fairtree is going to discontinue legal proceedings. This, of course, is all about the lawsuit here that we have seen, this potential lawsuit against SBB, the Swedish landlord, Fairtree dramatically scaling back its holdings of bonds at the centre of the case. And you are seeing Fairtree saying that it's going to discontinue the legal proceedings. So you're seeing the fallout there, now 9% up on SBB. We're going to have plenty more coming up on the programme, so do stay with us. This is Bloomberg.
"18 minutes into the session, let's call it 19 minutes into the session. Energy is outperforming by some considerable margin. It's up by 0.8% as a sector. Most sectors are tracking lower this morning. European equities are down. Industrials, technology, media, the lead losing sectors this morning. This is the beginning of a week that has an awful lot going on within it. And we're already having to factor in, obviously, what happened Friday. We're also, with the payroll number, and we're also having to factor in what is happening with the oil price, which is now at its highest in more than 4 months. So what happened Friday was the US announced, the Biden administration announced a fresh set of sanctions on the Russian energy industry. It's going to have a big effect. It looks like it's going to have a big effect, much bigger than anticipated. So a barrel of Brent is now fetching more than $80 a barrel. That's the first time that we're seeing that since July. Stephen Stapczynski joins us now to talk about all of this. Stephen, the world thought that we were coming into 2025 with a lower oil price as pretty much the base case. The oil prices were going to move lower. That was going to be the narrative. It was going to be a part of the disinflationary process. Why is this not happening?
You know, Biden threw a wrench in everyone's plan to a degree. Now, what you might remember over the last 4 years, the Biden administration has been very careful about not directly sanctioning exactly Russia to that way it could curb the flow of Russian oil. Now, this is a little bit different. Instead of a price cap, they've gone directly to Russian oil tankers that are part of the shadow fleet. Over 150 of them have been sanctioned. That's the biggest package ever. They also sanctioned Russian oil companies, the ones that help to ship the fuel, and they've also sanctioned Russian insurers. All of those together could take 500,000 to 800,000 barrels a day off the market. That's a little bit less than 1% of total supply. But still, when you're in the oil market, even 1% is enough to kind of lift prices a bit. Now, we don't exactly know how it's going to shake up, but there's another risk in the market as well, which is Trump. And there's expectation that Trump is going to put harder sanctions or enforce the existing sanctions on Iran, which is another major oil producer that had been using the shadow fleet. So if you put just the latest Russian sanctions and the potential for Iranian sanctions, oil prices could continue rising. And Goldman said in their note today that if both of those things happen, you could see Brent go from where we're at the $80 level right now up into the $90 level. And that is a bit of a price increase considering, as you said, we were expecting more of a frothy, bearish year coming into January.
Yeah, really a nightmare for the Fed potentially, Stephen. How do you weigh that, though, when you've got other factors going on here, storage, the weather? How big is this influence of the new restrictions?
I mean, I think we have to wait and see what the restrictions mean. I think everyone is looking at the different worst-case scenarios, but it really is a matter of, will Russia be able to find a way around them? And also, will Trump keep them? It would be politically difficult for him to remove them, but it is a possibility that he could. Now, there are other factors, as you said. Cold weather in the United States and in Europe have led to a drawdown or increase in demand for diesel and other products that are used for power and heating. In the U.S. in particular, inventories are also falling. But it's a complicated picture because you also have to look at demand. Chinese demand hasn't really been showing up. It's consistently been weaker than what the market was expecting over the last few years. So it's not a really easy up story, but certainly because of the sanction action on Friday, we are seeing a more of a bullish element in the market going forward.
All right, Bloomberg's Steven Sipchinsky walking us through that oil story. We thank you so much. We're going to stick with the energy conversation as well and go from oil to natural gas, where futures are up this morning. It comes as Europe risks failing to meet its natural gas storage targets for next winter, as well as some reports around attempted attacks on the Turk Stream compressor station as well. All of that moving the market this morning. Priscilla Azevedo Roca joins us this morning to talk about all of it. You sat down, you said, the minute I started talking about storage, suddenly the conversation changed. Give us, audience, a little bit more insight.
The conversation has changed because there's more risks now coming into the market. We are already very short on supplies. We're falling low on stockpiles, as you've mentioned. And Europe this year, it's scrambling to meet its energy needs because simply there's less supply available. Turk Stream, what we know so far is that flows have not been impacted, but it presents a new risk to the market, and the market is reacting to the possibility of something else being disrupted on top of everything else that already happened this year.
Just remind us, what comes through Turk Stream? Where does it go? Why is this important?
Right. It's Russian gas. And is the last remaining route to Europe after we had the Ukrainian one ending at the beginning of this year. And it feeds Southern Europe through Turkey to Hungary. It can go all the way up to Italy. So it's the last remaining route of Russian gas to Europe.
So then where are the pain points? Where are the shortfalls going to be felt?
Right. With less supply available in Europe through its pipelines after losing the Ukrainian route as well, Europe has to put itself out there and buy sea cargoes and buy LNG. At the moment, there's not a lot of LNG available because those projects, they're slow to pick up and they're coming online slowly. We've seen some from the US, we've seen some from Canada, but this year they're going to be short, which means that Europe has to keep its prices up to compete with other nations to attract the supply here. That means that other countries that deeply need this LNG to keep its lights on, like Egypt, who has become a net importer last year for the first time in history, will not be able to pay up and compete with Europe.
Let's bring it back to the initial kind of drive for having you on the program this morning, which is simply that these storage issues continue to stay there. We've gone about, I think, maybe 3 or 4 years now, where every winter we say, this is going to be the crisis. This is going to be the crisis that breaks Europe. And every winter we've gone by saying, well, the weather's a bit warmer, so we haven't hit that breaking point. How much closer are we to that breaking point?
Right. This year, the weather has been extremely cold. It's the first colder winter since the energy crisis, and we are seeing the storage levels in Europe falling extremely quickly, more than any time in the past 5 or 7 years even. Right now, storage levels, just to put into a bit of context, they are 66% full compared to 80% at the same point last year. Storages, just to be clear, they're meant to be a buffer. So they're meant to be used on times of stress. But what is going to make it, it's going to make it harder for traders to stockpile in summer. Let's say China, it's a very, very hot summer in Asia, and China will start out bidding for cargoes, and European traders need to start stockpiling for next winter. And that's when the problems are going to start to arise, and we're going to see the pain points. 90%
storage levels mandated by the 1st of November. Europe's going to struggle to get there by the sounds of things. We'll leave it there. Priscilla, thank you very much indeed. Priscilla Azevedo Roca joining us on what is happening with the gas story. We'll come back to that a little bit later on. It's potentially going to be hugely inflationary for Europe. You're going to see that maybe showing up also already this week in the UK CPI data. Pay attention to that. Up next, we'll talk about why we haven't seen fireworks this morning. Bezos' Blue Origin space team have delayed the inaugural launch of the new flagship Glenn rocket. We are going to talk about what has caused the delay, when are we potentially seeing this launch, and why is it so significant? We'll come back to that next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. It's red across the screen here in Europe. The stock 600 lower 0.7%. The FTSE 250 had been managing to eke out some gains, the only one actually, but maybe that is after the pain of last week, a little bit of a reversal there. But if you look across sectors, all but three in negative territory this morning. Energy, basic resources leading the gains as we had expected, given the oil price moves. Brent trading up 1.8% currently, just above $81 a barrel. But let's get to one of our top conversations now. The global co-head of UBS Wealth Management saying that Beijing's more proactive fiscal stance is going to be as relevant this year to markets as what's happening over in the US. In an exclusive interview, Iqbal Khan also told us how he sees a slower pace of Fed cuts affecting investment decisions.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
Iqbal Khan, the UBS Asia-Pacific president and co-head of UBS Global Wealth Management, speaking exclusively to Bloomberg Television. All-weather portfolios. At the moment, the market is dealing with knowns, known unknowns, and unknown unknowns. And I wonder where the California fires fit into that overall narrative. The weather, certainly, all-weather portfolios playing an increasing part in how people are positioning. And Kriti, you just think about the implications of what is happening here. The National Weather Service is issuing a particularly dangerous situation warning for Malibu, San Fernando Valley, portions of Ventura County. These are big metropolitan areas, big areas with a lot of very expensive real estate in them, some of which is going to have a mortgage on them, some of which is going to be hard to rebuild. I wonder whether this is also going to show up in the bank story this week. I don't yet know that we've got our arms around the economic implications of what is happening here.
Absolutely. The liability insurance as well, as you mentioned, is going to be a key one. And the ripple effects, by the way, to the insurance markets around the world, because so many people are exposed to that globally as well. You mentioned the economic piece. 15% of America's GDP comes from California. So this is going to take a big hit. We're talking about export data this morning out of China. That goes straight to the LA ports, which is also likely being impacted by this as well. Not to mention, from an economic perspective, how much of the government funds are then, in the first days of Donald Trump's presidency, going straight to California. That's already been 100% covered, according to Joe Biden.
Yeah, and it looks like it's going to get worse this week. Another round of hurricane-force wind gusts expected. Some of the biggest fires still going and out of control almost at this point. You can see them on the screen there.
Yeah, you're looking at pictures that are just so dramatic, and you think about how hard it is going to be to rebuild after this. What are the rebuild costs? Costs of rebuilding are enormous. The value of these properties as well has skyrocketed recently, makes kind of the balance between the mortgage, the rebuilding costs, the kind of who holds the liability. Is some of this stuff economic to rebuild as well? I think is going to be a key question. And again, I wonder, where are these mortgages held? Where does the risk lie? Yes, the insurance is a risk, but if the insurance doesn't hold up, the mortgage then becomes a risk.
Yeah, and this has a municipal kind of bond story as well for those who are exposed to California municipal bond. This become a major political conversation, and not to mention kind of the second wave effects of how this all shows up in terms of ESG investment around the world, given that so much of the ripple effects from these fires and these Santa Ana winds and hurricane winds are really tied to the climate story at the end of the day. We're going to dive into all of those details, I'm sure, in the coming months and perhaps years that it's going to take to rebuild after the fires are eventually put out. I want to go to another major story we're following this morning, and that, of course, is Jeff Bezos' Blue Origin, which has been delaying the inaugural launch of its new flagship rocket to deal with an unspecified issue on the vehicle. We were, of course, waiting for that launch just moments ago before it had been scrubbed. Watching this very, very closely is Bloomberg Aerospace reporter Kate Duffy, joining us around the table for more. So let's just start with the latest news. Why was this scrubbed?
Well, it was scrubbed because of a troubleshooting issue. So there were clearly anomalies with the vehicle subsystem. So that meant that it couldn't go ahead today. But it's just, this isn't a particular issue. This is what we sometimes see with rocket launches. They do get delayed. It is normal, whether it's down to the rocket itself or weather conditions. But we have been waiting for this launch for a long, long time. This has been in development for more than a decade now. So it's just about getting it off the ground and seeing how it performs.
Kate, we know that the space race is really about who has the biggest rocket. How painful is this for Jeff Bezos and his rivalry with Elon Musk?
I mean, he's come out recently and said that, you know, it's positive that SpaceX is doing so well and Blue Origin is hopefully going to do as well. So they've got very similar rockets in the sense that they're both delivering satellites into orbit. SpaceX's Falcon 9 is reusable. It's probably the most reliable rocket we have on this planet at the moment just because of the frequency of the launches. So New Glenn is supposed to do the same thing, deliver satellites too, but at a heavier payload, so delivering more at the same time. But we're just waiting to see whether that he can actually pull this off. Obviously, it's a big moment for him. Blue Origin, the space company, they've already taken space tourists into space. So this is a separate sort of division to the business and something that, yeah, would compete definitely against Falcon 9.
The comparison with SpaceX is obvious, and they have similar rockets and they're trying to do similar things, but how different is the ethos at these two companies?
Well, SpaceX is extremely competitive. They're doing sort of smaller, obviously they're big launches, but smaller steps in the launch. So, for example, Starship launch, the test flight is coming up. And that will be very similar to the last launch that they had a few weeks ago, but it will deliver these fake satellites into orbit. Whereas Jeff Bezos is taking a more sort of cautious approach to it, where this has been in development, as I said, for more than 10 years, and this is the first launch that they're having. And this is supposed to do everything in one launch. It's got the payload on board already. It's going to deliver the satellites, and it's also going to land for the first time on a ship in the ocean because it's reusable, just like Falcon 9. So they're doing everything in one go, and that is different from how SpaceX have operated in the past.
Well, talk to us a little bit. I mean, at the end of the day, there are business implications. As Guy mentioned, there's kind of, you're competing with SpaceX, but you're also not competing with SpaceX, and then ultimately you're trying to contract with NASA at the end of the day towards some of these space loads. I mean, I think Jeff Bezos as well, commenting in a Bloomberg interview this morning that there are going to be multiple winners at the end of the day of this industry. To what extent are those kind of the next steps from NASA and the kind of the federal standpoint almost contingent on Blue Origin's success here?
As he said, he's positive that SpaceX is in the business as well. But also, the new Trump administration is supposed to be very pro-space, so he's focused on that. He's not worried about the other competitors that come into the space race. If anything, it encourages each other for competition and to reach space. And obviously, it puts America at the top of the leaderboard when it comes to reaching space, the moon and Mars as well. So, yeah.
So when do we have any idea when this thing's going to go?
No, they haven't released a new date yet. We're just waiting for that.
So is that an indication that this is a more major system failure or major system gremlin that they're worried about?
Not necessarily, no.
Right.
It could be that they have to get the fuel out of the rocket and just for safety reasons. They have to delay it by a week, potentially. It could be a couple of days. We're not sure at the moment.
So we've been on the edge of our seats all morning and we'll have to stay there.
I vote for Saturday. I think Saturday would be a great launch opportunity if you're watching, Jeff Bezos.
Not between the hours of 7 and 9 a.m.
Monday and Friday, basically.
Duffy, our Bloomberg Aerospace reporter. Lovely to have you with us round the table. But coming up on the programme, the UK Chancellor Rachel Reeves returning from China with deals worth £600 million. Is that going to be enough to ease the broader market concerns? We'll dive into that next. This is Bloomberg. Welcome back to the opening trade. We're 44 minutes into today's session. It's red across the screen for European equities. But if we focus in on the UK this morning, the FTSE 100 is down 0.3%, FTSE 250 down 0.1%. That links into the pound story. So the pound's taken a leg lower this morning, down 0.5% at $1.21. And in the gilt market, you've got yields climbing again this Monday morning. So on the 2-year high of 5 basis points at 4.5%, the 10-year high of 5 basis points at 4.89%. And this is after the Chancellor Rachel Reeves over the weekend tried to calm things down. Of course, she's been in Beijing. She's been trying to rustle up interest in that economic relationship. But journalists, of course, asking about the market turmoil at home. She says she is wedded to her fiscal rules. Has she done enough? Let's get analysis now with our senior economics reporter, Philip Aldrich, who joins us round the table. Phil, good to have you with us this morning. Let me just start with the announcement from Reeves, this £600 million deal that she's got from Beijing. That's a drop in the ocean, isn't it, when you talk about China?
Yeah, it's very much small fry. It doesn't feel like it's clearly not a significant amount of money.
The visit?
I think obviously there's other things going on which they're discussing. I mean, because obviously the UK's energy transition, the clean energy transition that we're making, is going to rely enormously on China for the supply chain. So I think that there's a lot of talk on behind the scenes about those issues. But in sort of immediate £600 million investment announcement, I think everyone could just ignore that.
In terms of what we're going to see likely play out this week, we've got data coming up, we've got CPI data that the UK is going to have to do with and GDP data. How is the bank viewing all of this in totality? The governor was on the trip as well, remarkably quiet in terms of the commentary that he was making. What does he have to do this week? How will he be and the bank be viewing what is happening here?
So, I haven't heard directly from the bank, but people talking about what the bank needs to do would stress that clearly inflation. I mean, if we get an inflation shock, an upside inflation shock, we can expect a more sort of ruckus in the market. So hopefully we won't get that, but the bank's going to have to reinforce at some point through some of the speeches that they are absolutely stressing that getting on top of inflation is key. And then beyond that, they've got to be watching what's happening in the market to see if there's liquidity problems. So if there are liquidity problems, which there's not really signs of yet, then does the bank have to intervene? They've got emergency liquidity tools. You could, I mean, in an extreme case, they could stop active sales of QT. I mean, these things. I mean, as soon as you start,
that's extreme, is it?
Well, I would say that if the bank has to intervene like this, then they're kind of reinforcing the idea that there's some kind of emergency situation going on. So the last thing you want to do is to respond in such a way that you exacerbate the problem. So I would have thought that running out some of their liquidity tools, reinforcing the use of their liquidity instruments, a lot of using words rather than using actions would be the preferable way to go. And there hasn't, I mean, spreads have not blown out any more today. If you look, they've moved everywhere up. So the UK spreads are not relatively worse. Obviously, sterling is where you've got to keep an eye on this. But yeah, I mean, and the Chancellor's got to somehow give that absolute. You know, she said my fiscal rules are non-negotiable. So. We are going to protect the public finances. She's got to sort of reinforce these messages. But, you know, it's up to the market participants to decide whether they believe it's credible.
Where's the inflation risk coming from? Is it the upside risk from the West? Is it the deflationary risk from the East? Or is it the market, to your point, getting ahead of itself before any of the policy changes have come from any three regions?
So the inflation problems in the UK are still this underlying. We've got core services, which is higher than core inflation, which is higher than the sort of 2% rate that we're supposed to have. We've got services inflation, which is around 5%. So that's very much a concern for the markets because you can't. These are the second round effects that are very hard to squeeze out of the economy, and we've not seen it squeezed out yet. So I suppose the concerns are you've had a fiscal impulse from the budget, which will only push these up. You've had these NICS rises and minimum wage rise, so the payroll tax rise and the minimum wage rise, which businesses are saying we're going to push through into wages potentially, and then that's into prices potentially, and that is all going to put sort of this further pressure on inflation. So that's what people are worried about. More pressure on inflation at a time when the underlying level of inflation is already relatively high.
Phil's talking about the idea that maybe you don't want to upset the markets by doing something, because doing something implies that there is a situation that exists that needs something doing about it. But presumably, Lizzy, the pressure must be growing enormously at the moment for Reeves to do something, or at least say something that addresses this issue.
One might agree, but on the flip side of that, even Sarah Breeden, the Deputy Governor of the Bank of England, said that the moves were orderly, echoing Phil, echoing Darren Jones, her deputy, when he spoke up. Well, this is debatable, isn't it? But look at, as you make the point, Phil, compare it to what's happening in Europe and the US. Everywhere is having the problem, but it seems particularly pronounced in the UK, right? Phil, if this continues, we've obviously got these important milestones, the Bank of England read on the situation, the OBR read on the situation, but what are the tools available to Rachel Reeves other than kind of constantly reaffirming her commitment to the fiscal rules?
Well, first of all, I'd just say that obviously the market moves have not been orderly, but they're not at the moment in panic setting. So, but what can Rachel Reeves do? I mean, fundamentally, the issue is about lack of credibility with the fact that her headroom is so small from her side, from the debt side, rather than from the inflation side. But the concern is that she's going to have to be constantly coming back with new policy measures to fill her, to basically hold to her fiscal rules. So if she was going to intervene and do something, she should basically say, list out maybe a few policies that she is definitely going to pull out of the hat if necessary, so that markets or businesses know what will be coming. Now, this is taking that step is, as I said, I think that you do that and you're basically saying there's something to worry about here. But the last thing you want is what happened before the budget, which is we had in October, which we had 2 or 3 months of endless speculation about what was coming, and that led to all this uncertainty, and that itself caused all sorts of economic spillover effects in terms of depressing, sentiment. And so you don't want just another 3 months of or 2 months of speculation. You at least have some policy. So that's. I feel that's all Rachel Reeves can do. And then obviously the bank can do liquidity stuff should market conditions get more fraud.
A lot to dive into. Bloomberg's Phil Aldrich walking us through both the politics and the economics, mirroring it very nicely for us this morning. We thank you so much for joining us around the table. It doesn't just stop today, though, because there's plenty going on for the UK. On Monday, we do get Keir Starmer's AI speech. Does that really change the narrative around that tech investment story here in the UK? We will certainly find out. I'm going to stick with the UK before I go to the other regions as well, because we do get UK CPI on Wednesday and then those GDP numbers on Thursday. So that's the UK story. For France, we have plenty of ECB speak throughout the week, but the policy agenda, the French speech from the new prime minister into parliament happens on Tuesday. We'll see if that actually changes any of the conversation around the deficit. But I have to say, a lot of the kind of conversation this week is going to happen in the States. That CPI report on Wednesday, the bank earnings that kick off on Wednesday, bleed into Thursday as well, and then 2 major Senate confirmations. First of Marco Rubio for the new Secretary of State under the Trump administration, and then Scott Bessent, to talk about the potential new moves from the Treasury. So it's going to be a fairly exciting week.
Yeah, last week felt brutal.
Yeah.
This week? Yes.
Well, let's see what our very own Valerie Titel is walking through, because she's got plenty on your agenda. We've got plenty on our agenda. What moves the market this week, Val?
Look, I'm focused a bit more on U.S. CPI, because I think it might put to bed the recent narratives or the recent worries about inflation reaccelerating. If we look at what the Bloomberg survey of economists estimate is for core month-on-month, we're due to end that streak of 0.3s, and this month we're looking at getting a 0.2. So that kind of softer reading might calm the market down when it comes to those inflation readings. For now, you know, we have had many economists across the street slash their view on calls for Fed cuts this year. The big one being Bank of America, saying that the Fed's rate cut is over, and they think the threshold for hikes is a reacceleration of core PCE above 3%. We're currently at 2.8, so it would entail a bit more of acceleration coming through inflation. I just don't think we're going to get that in the monthly core print this week, due out on Wednesday.
How much of a game changer was the payroll number? From just looking at this from an inflation point of view, the inflation print, we're going to go maybe 0.3 to 0.2. That's not it's a decent move, but it's not like a sort of huge move. The payroll number was really big. So it feels like the symmetry around all of this is that the labour market is looking super strong. Inflation slowly coming down. Does the inflation number going from 0.3 to 0.2 really change anything for the Fed?
Well, look, we're very sensitive to any more hints of inflation reaccelerating. We know that growth is holding up really well, but does that feed into a bigger term trend, a bigger shift trend in inflation? That's the big unknown, and that's the more likely thing that the Fed would have its eye on to react. But we got other things going on the week. Scott Bessent's Treasury confirmation hearing on Thursday will be a big deal. Let's hope he doesn't talk about how he wants to term out the debt and issue more long-term bonds.
If he pushes more treasuries rather than bills, then that's going to be fascinating.
Exactly. But you remember, Scott Bessent was brought into politics. He says the reason why he wants to go into politics is because he thinks the U.S.'s debt trajectory is on a unsustainable path. So he'll probably talk about, you know, the things that he wants to do as Treasury Secretary to calm the debt worries for the U.S. But it's going to be very interesting to see. Maybe he'll talk to us about what he thinks the recent rise in Treasury yields has been driven by, whether it's supply-demand dynamics, or maybe he thinks, you know, that the inflation situation is gaining more traction as well. It'll be very interesting to hear his thoughts.
What a week we have in prospects. There is so much to fold into this week. There's one thing we haven't talked about yet, which is the JP Morgan Healthcare Conference, which is taking place on the West Coast. We'll get probably more news, therefore, for sort of first thing tomorrow. This is a huge event. We've got some great coverage lined up as well coming out of this. But this is a sector that is going to be impacted by Trump. It's going to be impacted by drug discovery. We've seen what's obviously happened with Novo Nordisk recently and the big share price moves you've seen there. This is going to be a huge event coming up. Katie Greifeld's going to be live for us from that event. It's taking place in San Francisco next couple of days. I think Sam Fazeli's going to join us first thing tomorrow morning to talk about that as well. She's got some great guests.
Yeah, a pretty stellar lineup. The Eli Lilly CEO, for example, the main competitor of Novo Nordisk for some of those kind of weight loss drugs as well. You've got Teva Pharmaceuticals, the CEO there, plenty of the
Emma
banks as well.
She's going to be there, GSK CEO.
Yeah,
GSK. She's going to be talking to her.
Illumina CEO, just coming off that major court case with the EU as well. But I think you made the key point there, which is that pharma regulation out of the FDA under Donald Trump is going to be a key one, especially when he could be slapping kind of tariffs on some of the pieces that affect the sector.
I wonder who will be health secretary. We'll maybe look forward to that confirmation hearing with a great deal of interest as well. The opening trade is done. Wow, what a morning. It sets us up for an incredible week. We've got some great coverage coming up. The Pulse is next. Francine will carry the ball forward for you. This is Bloomberg.